how's it going, YouTube? Welcome back to the Capital Mindset Show. I'm your host, Fabio, and today we're going to be going over subscriber requests. The company is pretty much a cash cow. The main purpose of this business is to spit out dividends at this point, and I'll be going over what a cash cow is, and then I'll go over the company in question, and then an extra company to compare because they're in the same industry. So the first topic I'd like to go over is what is a cash cow? And this could be a cash cow within a business itself or one within your portfolio. Essentially, in basic terms, a cash cow is anything that has matured fully. And in this mature market, it is now simply acquiring new cash, right, to give to you. And that's its sole purpose. The growth is going to be very marginal because, again, we're talking about a mature industry. And the growth prospects going forward aren't going to be really priced in. So the purpose of this investment, or any investment that we put under the bucket of cash cow, will fit those desires. Okay. So the company in question is actually British American Tobacco. And as we'll go over a little bit going forward, it's a lot to do with the dividend. So a lot of people have a misconception of dividends. Some people have an opinion that dividends are bad. Some people have an opinion solely that dividends are good and the only way forward. Some people on the dividends are bad category will say that dividends are tax inefficient because you get taxed. However, you need to pay attention to exactly your tax situation, because there are a lot of instances in which you actually won't get taxed for that dividend. And I'm talking about depending on your bracket. As well as you might consider when to hold a position in a tax advantage account, because if you're in a tax advantage account, dividends actually shouldn't be a factor. Now, an important note, I think I should add, this could be a video all on its own to give a greater depth to this topic. But dividends are actually a great form of capital return, in some cases better than buybacks. And let me explain by that. So with buybacks, you are going to be assuming that the company itself is going to be doing so in a meaningful manner that will better the company. Okay, what I mean by that is you're assuming that the prices they do it at are going to be good. Okay, so then the question becomes, if you think the company's at a good price, right, then you would want more buybacks. If you think the company's at a poor price, then you don't want that many buybacks, but the company may do it anyways. So additionally with buybacks is it's not necessarily taking money off the table, right? So it is still going to be subject to the fluctuations of the market. And that kind of coincides with the first point. So if the company is buying at unfavorable terms or unfavorable prices, this could be actually a form of value destruction for the shareholders. And buybacks have a risk of doing this. And so there are companies such as, for example, IBM, General Electric, who have performed these buybacks in the past. And a lot of the airline companies, for example, are another example of that. They have done these buybacks in the past and even taken on debt to do so. And then that ended up being to the detriment to the shareholders. But remember, even if they don't take on debt, that cash, if that's used to not buy stocks at optimal times, then you can experience some value destruction. Rather, a dividend is taking the cash and giving it to you. So it's taking money off the table automatically. So I just want to say that to kind of help dispel some of the myths that it's not all black and white, buybacks bad, dividends good, or dividends bad, buybacks good. So just it's like what we're trying to teach in this channel. Investing is very nuanced, and every situation has to be looked at in isolation. And I think you can see that theme in every single one of our videos, or at least that's what I'm trying to get out there. So without further ado, let's actually take a look at the first company, which is British American Tobacco. As always, we're going to take a look at the price performance over time, and we'll see, for example, how they've been performing. I expect this, to be performing decently well over the longer term, but pretty bad over around 2017. So they actually went through an acquisition with an American company, and that's actually why they're called British American Tobacco. This is a company based out of the United Kingdom, and we've seen some companies out of the United Kingdom already on this channel. And what we tend to notice is that British companies are trading cheaply compared to their American counterparts. Now, based under that assumption, I expect to see that within the model. And the second company that we're going to be discussing, I'm just going to actually say it now, is Altria Group. So Altria being a domestic player in the United States, and it's a spin-off out of the Philip Morris company. So Altria was meant to focus just solely in the United States. Philip Morris being the international arm, we won't be discussing in this video, simply because they're not comparable on a valuation basis. Philip Morris is trading at the highest premium relative in the cigarette space. So we're sticking to British American Tobacco for now. We can see here that this price drop has pretty much been the stagnation of the business, or not the business, but at least the stock price going forward. Some people really looked at this as a buying opportunity. I'll actually take a look at that, but my hunch is it actually might be, depending on your strategy. And so that's the little note I'll put on that. So without further ado, actually, I think we'll just go ahead and take a look at the business. And I already plugged in some growth rates because I didn't want to take up too much of your time. And I wanted to show you how cheaply valued this business really is. And that's 20% required rate of return. Buybacks, let's remove those actually. So let's see what happens. Okay, so now we start to see, we have to ignore, actually, sorry, before I continue, we have to ignore that 16.66% average growth. That's actually from the acquisition. We want to actually lower those expectations and probably say they're more in line with inflation. So I want to say I'm not assuming that we're grabbing the dividend and reinvesting it. With this, I'm actually treating it like a cash cow. That may be something someone would like to do. However, we want to be cautious about the growth rates compounded over time, and we want to observe how the cigarette industry is doing in terms of its usage, et cetera. Now, I want to be clear that if some people will see British American Tobacco or Altria and say they're not going to invest in it for moral reasons, and that's completely fine. Every investor is able to do whatever they feel best for their own portfolio. So for the subscriber that requested this, I would say that you should keep that in mind, because a lot of people can think like that, and therefore there could be a permanent discount on stock like this. Now that actually can help you. For example, if a stock is perpetually hated on, but the performance is really good and it's returning capital to shareholders year over year over year, and that's growing and growing and growing, and you compound that over time, you'll actually generate tremendous amounts of return. And I'll discuss more on that when we get to Altria, because that actually coincides with Altria's history. So when we take a look at some of the metrics, we actually see that on a cash flow basis, this company is cheaper. I'm already looking at the enterprise value, and I can see that there's a decent amount of debt. Dividend yield in the 8% range. So again, I'm assuming in the model that we're not going to be reinvesting those dividends. So your share count actually isn't going up right now in the model, or your percent ownership at the end isn't going to be going up. So based on these assumptions, I'll actually say that I'll weight it more towards the bottom, and I'll say that this one perhaps will have, I'll change actually this to 6%, because, all right, so this is kind of telling me, again, assuming no accretion over shares over time, that I should be allocating around 2.21% based on the risks that the model sees with the growth rates that I'm assuming and my required rate of return. Okay, so in the offset chance that it hits 15% growth or 12% growth, I put those weightings at 10% together combined, that I think that the majority of the growth will lie between 5, 8, and 6%. And if I'm being honest, I actually should probably weight this 5 a little bit more, because I do think that the growth rates will be kind of subdued, more in line with inflation rather than anything else. But again, I'm assuming no additional shares over time. So you may think I'm being a little bit conservative there. All right, so looking at the key ratios, we want to see them getting better over time. I have the column on the right to kind of help everyone who's watching along and may not know what each one is or when they're getting better, to let you know. So on the solvency ratios and liquidity ratios, we're going to be seeing the health of the balance sheet. And on the current ratio front, they've been pretty much terrible all the way across as far as the model's measuring. And on the cash ratio, same. So what I know about this industry, and again, you see the investment game is very nuanced. So this industry doesn't like to keep a lot of cash on the books because of the added risk of not legislation, but litigation. And so it tends to be, and we'll probably see this with Altria, it tends to be the case that They do not carry too much cash. Their priority is, again, being a cash cow and delivering that cash to the shareholder. So gross profit margins are rising over time. That's good. And then operating margins are rising over time as well. Net profit margin also rising over time. Earnings quality is good. Okay, it's pretty good. And then free cash flow margin, book value per share. So this is actually trading below book value per share. That's quite interesting because I tend to not think that these types of industries should be trading at anywhere close to book value per share, but it depends on what management is valuing the book at. So we'd want to actually do more research. If you're curious if that's an issue, I would actually highlight that as an area of research. The activity ratios, I'll actually let you guys pause here, but the activity ratios for this kind of industry to me doesn't matter too much. In some sense it can, but not too much, because it's kind of a mature market. They have the market share that they have. And then, so basically the more important thing to actually pay attention to is the overall market as a whole, and what's the percentage increase or decrease. So now let's take a look, or have a little bit of a discussion about Altria. So Altria is again, the spinoff of Philip Morris International. And when they were together, they were one of the best performing businesses, or actually one of the best performing stocks in the entire history of the stock market. Now, this is if you include the reinvestment of dividends. So if you had reinvested the dividend ever since the initial IPO of Philip Morris International, it has returned a stupid amount of money over that time period. Because again, not only was the dividend reinvesting, because you're taking, again, cash off the table, but you can selectively reinvest. But let's assume you just kept reinvesting the dividend and you compounded it that way. Not only was the dividend growing over time and your shares were growing over time, but then those two added compounds, right, on top of each other, coincided with growing market, et cetera, growing business, and then continue forward until about the time when cigarette companies started to get hated. Then you had the perpetual devaluation of the companies. They traded at a lower multiple than in the past. Now, what that allowed an individual to do was now reinvest at higher yields. And then this reinvestment at higher yields allowed the compounding rate to go even faster. So remember, when you actually do benefit in a lot of ways if the fundamentals, right, are strong, and then the stock price itself is actually muted for a while and allows you to accumulate. And then if the company is returning cash to you and you keep reinvesting at those high yields, then you have a recipe for a tremendous amount of returns. So also, you've actually had quite a bit of spinoffs if you had owned Philip Morris, because at one point, Philip Morris owned a bunch of companies that you may know of today: Kraft, Mondelez, NBC Universal, I believe, as well. And not that you would have shares in all of those today, but you do have, I think in some of those you would have some shares, but not in all of those. I think some of them they sold completely, and other ones they just spun off. So that being said, I also want to highlight that currently Altria has a 10% stake in Anheuser-Busch. So this came from the acquisition that they had, I think, with Miller's. So they owned a huge stake in Miller's, and then when Anheuser-Busch acquired the company, part of the deal gave shares to the owners, and then one of the owners being Altria. So Altria has that added diversification. They have a wine business that they actually recently just sold to focus on their core business. And a lot of the focus of Altria and Philip Morris is on the IQOS, which is basically smokeless tobacco products, which they believe is the future in terms of tobacco usage. And they believe that it's less harmful, et cetera. So at the end of the day, the company itself does view its customers as cash cows. So if they can generate the equal sums of income while also not causing their early demise, this would actually over the long term lead to a higher valuation per customer. Okay, so it actually is to their market incentive to provide a product that doesn't cause damage to their lungs, et cetera. And also it can remove the long-term stigma in some form. So British American Tobacco has the benefit in this case, or at least I believe in this case, because in the international markets, at least in Europe and a lot of other parts of the world, smoking isn't viewed or as frowned upon as in the United States. United States is quite unique in its stigma against cigarette smoking, or at least North America. Now, if you step into the realm of England, if you go there for yourself, you'd actually see there's a lot more individuals who are more inclined to engage in the act. And British American Tobacco, being from there, has that advantage. Altria can't sell in there because of their agreement with Philip Morris. So Philip Morris, ergo, trades at a higher multiple because it's now considered the safer stock. And then Altria by itself is considered the riskier stock. So it's trading far cheaper. It's actually trading in line in terms of cheapness with British American Tobacco. So also another thing to note is Altria has been making investments into the marijuana category. And in this case, it's invested in Kronos Group. So Kronos Group is currently a non-profitable MJ stock. And if you guys want me to do an analysis on Kronos or other MJ stocks, let me know. I'll just let you know that since a lot of them are more or less in their startup phase in some sense, they are still escalating. So a lot of them are going to fail. A lot of them are going to fail. So you have to be very careful in that industry. Some people believe that it is optimal to play the ones that the bigger players are playing with. So for example, Kronos Group, but you got to be careful with that logic. You want to, again, judge it in isolation, not just make broad arguments. So we want to know that if Altria succeeds in that, that's kind of like a call option on the stock, because then they may be able to leverage that company and then probably become the Marlboro of MJ. Okay. So that being said, we can kind of continue looking at the company. So let's again start with the stock price and see what's been going on. So if we take a look at the 5-year, we see a similar story. And then we take a look at the max again, we see a similar story from 2017 was the peak. So all the cigarette companies pretty much had a era of overvaluation and this exuberance up here. So if you were looking at Altria from this point onward, from here to here, you saw only positive things being talked about. And then over here, you started to see all the negativity, right? And I'm not saying it to be cynical and say, oh, it's a buy, but it's something to note that when things are going down, you'll see more negativity about it. And then, so if we see from the longer term, it actually doesn't have its full list, but since IPO, but if you had even bought down here and invested and reinvested the dividend, it would be a lot more than this. Okay. A lot more than this, because that's, again, this is a cash cow, and that's pretty much its purpose in one's portfolio. And they acknowledge it too, because you can see by their dividend policy, they're paying a stupid amount of the profits to the shareholders. So again, let's take a look at the model, and I think I have similar growth rates, if not the exact same growth rates. And for this, I'll actually assume the lower buyback and assume we take all of the cash. Yeah, that's the wrong percentage. All of the cash that they give us as a dividend, and we just take it. All right. So if you want to be a little more aggressive, you would put it in. So what we see here right off the bat is it's a little more expensive than British American Tobacco, but only just slightly, because even at the 10%, we're getting very close to that $44 mark. So we're actually very close to the buy price, in which I would want to then, or be able to assume a 20% rate of return going forward. Now, a lot of the growth, again, if we take it back, I'm just assuming the valuation of the cash flows. If I take into account that they're going to be growing the dividends over time, and then that again accumulates my shares, I'm not taking that into account. So then I'm not taking the dividends out. I'm just taking them as the cash itself and valuating them in that moment, and that's what the model is doing. So I'm not putting or changing the ownership structure of the business. So that this 20% includes the dividend is what I'm trying to say. So I'm sorry for that little spiel. In English, the 20% includes the dividend, which is about 8%. So it means that the capital gains is going to make up for the rest to get there. Now, looking here again, like I said, it's a little more expensive. So the model is telling me to have a negative percent allocation, which basically means you could interpret it in a couple ways. You could interpret it as shorting it, but I would not short it. Instead, what I would say is we perhaps can make me have a lower assumption, right? And then we can kind of get some more context. So if someone wanted only a 15% required rate of return, this company can probably fulfill that at the current price. Again, you may think that my growth estimation is actually too strong. So I will actually kind of lower that. And let's say it's 1%. So at 1%, we actually got this price. And this price actually was during the drawdown during the pandemic. We got really close to that price at one point. I think we hit that price. If I actually zoom in, let me actually confirm for us. Did we ever hit that? We got 34. All right. We basically hit that price. So at 1% growth in cash flows, we could have gotten, or an assumed 15% rate of return. And that's pretty healthy for what it is. And then again, this being a cash cow, what more or less it would serve is to extract the dividend and pretty much reinvest it elsewhere. And it's pretty much valued on that dividend. And actually one way to value a company like this is actually the dividend discount model. So the dividend discount model is a fairly easy equation to use. You can actually look that up and what it is. And a company where a lot of the value actually comes from the dividend, it is a fairly decent tool to come up with a valuation or buy price. So that's just another food for thought. And I wanted to actually, I didn't even cover, you guys might have seen it, but I'm going to cover for those who may or be just listening. BTI is actually rated as a buy as well. And it's a 26.3% upside from here, according to analysts. So again, we already talked about our model, and then that's just the analysts, what they come up with. And then Altria, you can kind of see here that they do think it's a little more expensive than British American Tobacco, but it's also rated as a buy with a 53.78% price target, or 21% upside potential. And that's, again, according to the analyst. We have discussed our model here. So what you can conclude from here, or at least I can conclude by looking at this, is Altria is more or less in the same ballpark. However, it is trading slightly more expensive than British American Tobacco. Okay. And that may be, again, because of that British discount we're seeing. And there's actually a global discount when compared to American equities. American equities are very richly valued right now. And global equities tend to be right now very undervalued to their American counterparts. And I'm talking about the companies that you can actually own shares in. Everyone knows what I mean by that. So that's pretty much it for these two companies. I think that, again, the dividends or the dividend strategy has a place. And actually for some investors, I think it's very fitting for them. And you got to be honest on your type of psychology or temperament, because whatever keeps you in the game, whatever keeps you going in investing is, I think, the strategy one should implement. I don't believe in the one size fits all. For me, for example, I'm kind of like a jack of all trades investor. I don't really pigeonhole myself into one different category. What I consider myself at the end of the day is a value investor, but not in the value investor definition in like the textbooks, which, if you can think of it like that, it's like the guys who just look for the cheap stocks, because it's cheap and in relative to what, relative to its growth, because everything has to be, again, nuanced. It depends on what we're looking at, depends on what the prospects are, and then we consider what price to get it at. So that's pretty much my personal opinion about that. Again, if you are a dividend investor, this may be something you might be interested in. For me personally, it's not part of my portfolio. I don't plan to make it part of my portfolio, but I never say never. I may. I think I discussed with Austin. I think for other reasons, he may not be adding this position to his portfolio. But yeah, I actually enjoyed looking at these two companies. If you guys have any other requests, you guys can put them down in the comments below, or go on our website and you can fill a request there. The ones on the website actually go to our email, so that's a little more organized for us. But yeah, guys, if you guys like the content, please feel free to leave a like. If you're not subscribed yet, go ahead and subscribe, and then you can see more content like this, and then you can see more analysis and always these little nuggets that we tried to leave behind. Thanks, guys. If you guys have any questions, drop them down below and I'll get back to you guys as soon as I can.